Hey, do you want to know what the hell's going on in the insurance business here on the island of Maui and the state of Hawaii? Well, I am got the answers to the questions for you, not from me, but from Jamie Peacock. He is going to bring us up to speed on what happened, why it happened, what's going forward, and what we are to expect in the insurance business. Hey, Jamie, welcome to the show. I appreciate you joining me on our YouTube channel and enlightening us about the crazy world of insurance.
Hey, Tom, good morning. Thanks for having me. Everybody that is viewing this, my name is Jamie Peacock. I'm an independent insurance agent with Insurance Associates, meaning independent. I represent multiple markets and I try to find the best solution for my clients, whatever comes across my desk. That can come in the form of personal insurance, condo owners, homeowners, auto, and then I do a lot of commercial insurance. So I'm here to talk today about the state of the insurance market in Hawaii. It's no secret. It's been on national news. The Lahaina fires on August 8th of 2023 sent our market into a tailspin. A lot of folks.
Understatement, Jamie. That is an understatement.
Yes.
So, and along with other things that it's done to our, real estate market as a realtor here, it's one of the many things that has created grief. But so let me ask you, where were we at before in insurance, and what's been this transition now with the fire and all that's happening?
Yeah. So what nobody realizes or what nobody wants to talk about is that since the year 2020, the insurance market has been in a hardening phase. So just like the real estate market goes through hard and soft phases, the insurance market goes through hard and soft phases. So due to worldwide and mainland United States natural disasters, from 1980 to 2020, if you are a insurance bigwig in a corner office somewhere looking at what weather's going to do and what your loss experience is going to do, you could predict with certainty that there was going to be an average of about 8 natural disasters that cause large insurance payouts every year. And the insurance companies could price that, okay? Starting in 2020, we had multiple years, 21, 22, 23, where there were 18 of these large natural disasters, 23. I think in the year 2023, including Lahaina, there was 28 recordable disaster events. So remember, the insurance in the United States. Okay.
Wow. And you said typically before that there was 8-ish.
Yeah, from 1980 to 2020, that doesn't mean every year there was 8. It just means that on average, there was approximately 8.5 large natural disaster events that the insurance industry was used to pricing into their primary pricing, and the reinsurers were used to pricing into their reinsurance treaties.
This whole reinsurance thing, we'll get to that, but that is something that I think is this nobody even knows. No consumers or very few really know what it is, but we'll talk about that later because I just want to point that out. If you're saying what the heck is he talking about with reinsurance, we'll get there. But okay, I'm sorry for cutting you off.
What no one realizes is the market was heading into a drastic hardening period ever since 2020. We were seeing rates start to creep up in 21, 22, 23, and then the Lahaina fires were essentially the straw that broke the camel's back as far as pricing and coverage in our market. You got to remember, Hawaii only has 1.5 million people. Okay. We are not a large market. California has 50 million people. So if you're an insurer writing business in California, forget about the wildfires and all that stuff. You can spread your risk over 50 million people. Here in Hawaii, not only are we a small state, so we can't generate the large amount of premiums like the New Yorks, the Floridas, and the Californias, but we have all the catastrophic exposure. We're subject to tropical cyclones. Now, are we a high-risk fire state? The insurance industry thinks that we are. So the market was headed in the wrong direction before the Lahaina fires, and that event put us over the edge.
Can I ask you, so when it comes to insurers, like, we know State Farm, Prudential, the big names, and there's a lot of little names. Do you have to be licensed to insure in every state? Can any company write an insurance policy, any that the end I guess the end user insurance broker or end user insurance company, can any company write in any state?
In general, yes. I don't want to get too far into the weeds,
Okay.
but in order for an insurance company to write business in any state, there's two types of insurance companies. There's admitted insurers and non-admitted insurers. So when you think admitted insurers, think State Farm, Allstate, First Insurance, Prudential. Any company that you see advertised on TV is an admitted insurer. What that means is an admitted insurer must file their rates with the state that they're doing business in. And the Department of Insurance and the insurance commissioner regularly examine them for financial stability and other financial factors to make sure that they're doing right by their customers. If a policyholder, and that, it could be a business policy, it could be a piece of property, a house that's very, very far from a fire station, for whatever reason, if a policyholder does not qualify for an admitted, or just call it a normal insurance policy,
Right.
then as a broker, I can go into the secondary market, or what's known as the surplus lines market, and I can secure coverage for them there.
Okay.
Secondary market, surplus lines, they are not subject to examination by the Department of Insurance. They are not subject to file their rates online. It's essentially an open market. So when no normal insurer will do it, we don't have a choice as agents but to go to the secondary market to secure coverage for that person. Okay.
Got it.
So when you think secondary market, think Lloyd's of London, think Axon Specialty. You won't see stadiums and advertisements for these types of companies, but for instance, AIG, everyone's heard of AIG. They're a
Right.
multi-billion-dollar insurer. AIG is admitted. Lexington, one of the largest property insurers in the United States, is AIG's surplus lines division that takes all the high risk stuff.
Okay.
Okay.
So it tends to be higher risk. But does the consumer really understand that when they get an insurance policy? Is that explained to them?
It's plastered. Yeah, great question. So it's plastered all over the documentation that we provide in the form of quotes and the disclosures that they sign off on. Do they understand it? I don't know. But as an agent, it's written into the state law. I cannot place a piece of surplus lines business unless I've been declined by 3 admitted insurers. So my job as an agent is to take a risk to the standard market. And if the standard market won't take it, then I continue on my journey.
Okay. That's good to know. Wow. That is something. I've been in this business, and as a realtor, I didn't quite, because I always just send my clients to go get insurance from a couple different places. And so that's really great information. I think that's something that's just an aha moment for me to get.
Yeah.
Okay.
Absolutely.
So let's keep going. So the market is getting crazy. There's way more catastrophes.
Yeah.
And the insurance market is now seeing this pressure, and then the fire happens. Right.
So fires happened August 8th, 2023. Tragic. One of your previous guests on one of your other shows was actually my very first call that I turned in. I got a frantic cell phone call at 5:30. Remember, we didn't know until the following morning that the town burnt down. But previous gentleman, Kevin, that was on your last show, he called me, brother, I'm looking at my house right now. It's completely engulfed in flames. I got to turn it clean. I just got goosebumps talking about it because I'll never forget the call. It was like the aha moment. I'm like, are you serious? He goes, bro, the whole town's on fire. What? They haven't made any announcement. They've just closed the road. Now we know the sad truth. Lahaina burns to the ground. There are over $7 billion in losses in Lahaina.
Wow.
And that is still relatively small for the global market. So give you an example. California, they're projecting $40 to $50 billion in losses, but because of the way their market is structured and a lot of state involvement, a lot of those losses aren't going to fall into the traditional fully insured market. Okay.
Right.
So after California, everyone was calling me going, oh God, are my rates going to go up again? And we didn't know, but the feedback that we're getting is Hawaii, its market, its reinsurance, and its pricing structure are pretty insulated from the California fires. So that's a kind of a newer, good piece of information for your viewers.
Good.
That California so far is not having any meaningful impact on the market in Hawaii. Okay.
That's good.
So moving forward to the Lahaina situation. Once you have a big loss like that, the first thing that happens is everybody and anybody writing business puts you under a moratorium. So I did a couple of quick reels and Facebook and Instagram feeds, you know, the other parts of the island that weren't burned. People were calling saying, hey, I need to finish off this real estate deal. I need to get a policy for this home in Wailuku or in Haiku, right? Areas not affected by the fires. We were under a total moratorium. And depending on the carrier, that lasted quite some time. So there was a freeze in the new business insurance market until boots on the ground could assess the situation. And it took a month or two, and then very strict underwriting in order to open the market back up, right?
Right.
So with regards to Lahaina, I'm going to jump into reinsurance, Tom,
Okay.
because it's an important piece of why rates are going up. So here's how I explain reinsurance. Let's use First Insurance Company of Hawaii as an example. They are our state's largest insurer. They have $400 million of premium that comes through the door. They have 115,000 policyholders. Okay.
Wow.
So 400 million comes in the door, 115,000 policies. Okay. They have $1 billion in claims in Lahaina. So if you and your viewers didn't know anything about reinsurance, if I just gave you the simple equation, 400 million in the bank, but we need to pay out $1 billion, that sounds like a problem. That sounds like there won't be enough. My insurance company is going bankrupt. Wrong. First Insurance and most of the admitted and non-admitted companies that do business in Hawaii, they purchase reinsurance. Reinsurance is nothing more than insurance for insurance companies. So using First as an example, out of those $1 billion in claims, those checks are coming from First Insurance. The money to fund those claims is coming on the back end from reinsurance. Okay.
Okay.
Without getting into more detail, what do you think happened to the cost of reinsurance after the Lahaina fires?
Sure, it had to go up because
Right. I don't want to debate whose fault this is, who's negligent, doesn't matter, right? The
Right,
fire hydrants ran out of water.
that's
This
not why we're
landowner, that's not why we're here. Okay. Alls I know, and all the insurance companies know, is that based on the events and either poor response, whoever's fault it was, the insurance industry that has to reinsure all of these companies in Hawaii now is going, fool me once, shame on me, fool me twice, that whole thing. So the rates of reinsurance have gone up. So let's say you had a $2,000 homeowners policy with First Insurance or Zephyr or HIG, and your rate went up 30 to 40%. Just like a restaurant passes on the additional cost of eggs, or a trucking company passes on the additional cost of fuel, these insurers must reinsure, because remember, none of them have enough money to pay all their claims, and they're simply passing along their increased cost of doing business here in this market. And you're going to see that continually as insurance companies reassess the risk in Hawaii. So reinsurance is very important. The good news for the viewers on this call is people have this perception, oh, insurance companies don't want to pay. Our agency insures over 1,000 condo AO associations. And I know of some of the agents in my office that have hand delivered 40, 50, $60 million cashier's checks in person to some things that have burnt down in Lahaina. So because of reinsurance, all of our insurers that were involved. You're not hearing stories about this insurance company going out of business, not paying
No,
claims.
I haven't heard any of that.
Right. So
What about like some of these condos, and I've heard this and I don't know if it's true, that were underinsured or that they
Yeah.
can't rebuild the property because there wasn't enough insurance in place. I don't know, and I'm sure that's probably happened to homeowners too, because I don't know if they were being frugal when they bought their policy or if their policy wasn't written properly. I guess is that a space you're comfortable talking about?
Yeah, absolutely. So in general, insurance, and I'm not talking about hurricane and earthquake. Those are catastrophe policies that cover one thing. And whenever there's going to be a claim, there's going to be a large claim. The domestic fire insurance or all risk insurance market. Tom, you have a homeowner's policy. I have a homeowner's policy. I hope it never happens to us, but God forbid there's an electrical arc or we leave the stove on or something bad happens and our home individually burns down. Okay. In general, I would argue that if that scenario, if one house or two houses burnt down in Lahaina, everybody with $300, $350 a square foot of insurance would have had enough money to rebuild. Okay. But because this was a large catastrophic loss that destroyed, I think it's 2,300 structures, 2,300, 2,700 structures, perhaps, because of the large nature of the loss, it created this vacuum, which is called economic demand surge. So now you have an island in the middle of the ocean, everything shows up on boats. Rightfully so, contractors are saying, hey guys, this is going to be $600-700 a square foot to rebuild. So are people underinsured? Yes, but they're underinsured because of this surge due to a catastrophe, which, again, I don't want to debate this, but due to the fault of others, depending on who you're following. The settlement you're seeing in Lahaina and the settlement you saw in the Paradise fires in California is to fill the gap between what people had and that economic demand surge. Does that make sense?
It does. Okay, that makes a lot of sense.
Now, are people insured properly today? First insurance, most of my insurers, I'm not writing anything. I repeat, anything for less than $500 a square foot. And we could argue that might still not be enough, but that's the lowest that I'll go if I'm insuring someone's house or someone's commercial building. If there's another agent out there, knowing what we know, still willing to do it for less, then I'm going to lose out on that deal.
And that's in Hawaii.
That's in Hawaii.
To anybody who's listening.
Yes, sir.
In a different market, it's going to be a different cost, but
correct.
Hawaii. Yeah. Okay.
Correct. Yeah.
Perfect.
So
then, can we talk a little bit about that settlement? Are you done with your thought there? Or?
Oh yeah. No, go ahead.
So can we talk a little bit about that settlement? Because I know we were at a meeting and you had talked about the settlement and if you get money, who's entitled to the money, and there was some awareness I think you pointed out that I thought was really interesting.
So remember I just talked about reinsurance going up. So one of the factors that's going to continue to drive the increased reinsurance, the Supreme Court in the state of Hawaii, in a very fast, if you know anything about Supreme Courts, both at the state, the federal level, they operate in an extremely slow manner. This case was decided in, I think, 12 days or 13 days. And they essentially fast-tracked this $4 billion settlement so that the victims and the families of the Lahaina fires could get relief right away, which I completely agree about. I agree with. What they also did is they said, hey, insurance companies, insurers, when there's a claim and it's perceived to be someone else's fault, they want to go after the party that's negligent, right? So Tom, if you're hit by another driver and that driver is negligent, and for whatever reason you're not getting proper claim service, you turn a claim into your own auto insurer. If they pay 10 grand on your behalf, your insurer is going to go after the other person's insurance to get their 10 grand back. That's
Right.
how insurance works. They're going to subrogate. The Supreme Court said, hey, insurance companies, you guys cannot and will not get a dime of this settlement. You are not entitled to subrogation against the settlement. So everybody that paid claims, and again, don't want to argue whose fault it is or whatever, but there is some evidence. You can blame the utility, blame the land, whatever.
Right.
And those insurance companies are not able to participate in this $4 billion settlement. So again, if you're a reinsurance CEO or an actuary sitting in a corner office, now you know what happened with the Lahaina fires, and now you know that if there's a disaster, the courts aren't going to let you recoup any of your losses from the supposed negligent parties. Okay.
Right.
And that's important. I don't know if that'll be the law of the land moving forward. I hope there's not another disaster in Hawaii, but if there is, now there's a precedent that
Right.
says insurance companies can't participate. So,
okay. So what happens if somebody gets money from that? Does the insurance company then try to go after the money from the individual, or?
yeah, so simple math, here's how it works. Because the insurance company can't subrogate against the fund, if a business owner with a small store received a $100,000 payout for their property policy, if they have signed on to and participated in the class action litigation, should they get any relief from that litigation up to $100,000 in my example, if they receive $100,000 from the class action settlement, but they've also received $100,000 from their insurance company, the insurance companies are going to put a lien on that first $100,000. They're saying,
and their loss was only $100,000, so it's like they're double dipping, and that's what
correct.
the company is saying. You can't double dip. We need to be compensated. Okay.
Yeah, you can't get compensated by our policy and then go out and get recompensated for the same loss without involving us, because we're not allowed to participate in the settlement. So they have no choice legally but to do it a different way. Most people understand. I'll tell you, those that did not have insurance, whatever they get, there's no insurance to put a lien, but they may not get enough. Let's say they have a house that burnt down $800,000. If they get $250,000, they're still going to be $550,000 short, right?
Right. Okay.
So, great question.
All right. So now fire happens. Insurance is in chaos. Insurance rates go through the roof, both for homeowners and the condos. And I think that's where we were seeing a lot of stress in the condominiums, where the associations were, they do their budgets a year in advance. It's like, oh, our insurance rate is $100,000. And then all of a sudden they get this new insurance and it's $400,000.
Yeah.
What caused that? Is that all back to that reinsurance and everybody not overreacting, but covering their butts, I guess, everybody being the insurance company. So give me a little bit of backstory on that.
Here's the backstory. When you have to insure a condo complex, and I'm going to talk about wood frame complexes. So there's a lot of those in Hawaii. Right. Think of Kihei, think of Lahaina side. Yes, there's a lot of tall concrete buildings. Those weren't affected as badly. But think about all three of our properties in Wailea, Ilua, Ikahi, Kolu. Then we have Keonukai. Just go down South Kihei Road, Pacific Shores, just keep going, South Point, Kihei Villages. These are 100% made of wood, okay? Before the fires, there was 3 carriers that were writing insurance on wood frame buildings. Lloyd's of London, Lexington, both surplus markets,
right.
Okay? And there was a company from Korea called Dongbu, or some people know them as DB Insurance. And they came in the market about 10 years ago with extremely aggressive pricing. They wrote a ton of, some would argue, underpriced business on wood frame. Once the Lahaina fires happened, they took on significant losses in the Lahaina area and put out a memorandum that within 2 years, they were going to non-renew 30 or 40% of their entire book of business in Hawaii. And it was all the wood frame stuff. So these condo complexes that had Dongbu DB were paying, let's say 120 or 150,000. Okay. And then you heard the horror stories after the fires, it went up to 1.2 million. Right. So let's take Dongbu out of the picture and go back to Lloyd's and Lexington. Lloyd's and Lexington have traditionally been the two secondary market insurers willing to take on that wood frame high fire risk, right? Before the fires, as agents, we could go to them and we could get an entire complex. I'll use South Point as an example, or Keonakai. The insured value of South Point is, let's say, $80 million. Before the fires, Lloyd's or Lexington would take the entire 80 million in-house. And Dongbu was doing it that way as well. Okay. After the fires, the decision makers within those companies said, "Oh, we just got crushed," and they did. Puamana, Ainanalu. I can't rattle them all off, but they got crushed. They said, moving forward, we are only taking the first $10 million of exposure at any frame complex. So the underwriter used to be able to get 80 million. Now they can only get 10 million. That underwriter had to go out to the market and get multiple insurers to participate in a layered program or a ladder and say, "Hey, insurance company A, B, C, and D, will you take $5 million of this 80 million, and how much will you charge?" The minimum premiums for anybody to dip their toe in the water right after the fire was $50,000 per $5 million layer. So if you got $80 million to fill, above the first 10, you got 70 million left. Simple math, 50 grand times 14 layers plus a couple 100,000 just for the first 10. There's where you're getting your million, 1.2. I don't agree with it. But that is what happened. Is there was absolute fear. Nobody wanted to take on more than just a little bit at any one complex, if that makes sense.
Makes total sense. So now, with that being said, I know everybody's insurance rates, not everybody, so many places went through the roof.
Yeah.
Are we seeing, is that backing off? Are they stabilizing, coming down? Are we gonna, as you're in the business, where do you see it going forward?
The good news for the consumer is we are starting to see 40 and 50% rate reductions. So a complex that went from 150 to 1.2, I just renewed a complex like that for around 600,000, exactly a 50% discount. Myself and the others on my condo team, we thought it would take 2 to 3 years for the market to soften. But once those premiums went sky high and the carriers saw that they could get 50,000 per layer, then everybody's wheels started turning. Well, maybe we can do that same layer for 25,000, right? So if you're a $5 million layer over 40 million, Tom, that means for the 25,000 or the 50,000 being collected, you're only at risk of paying a claim if the loss is above 40 million. So as you go up the tree, the layers in theory should get less and less.
Got it. That makes sense.
Right out of the gate, the fear and those not knowing, are we going to have more fires? Were these set by man? It was a knee-jerk reaction, and we understand the pain
in any market. I mean, we see that in all kinds of, whether it's insurance, stocks, we see that boom, those spikes. Yeah. And so, but I think bottom line though is that's wonderful news that you were able to write this policy from 1.2 to 600,000.
Correct.
But the kick in the butt is that 3 years ago it was 150. So it's still a lot of money. But for the homeowners and the associations, it's wonderful to see that we hopefully will see that insurance costs tailing down. And is this on a wood structure building as well?
Yeah.
Again? Okay.
This is wood frame. And
What about I'm sorry, go ahead.
oh no, I don't think we're never going to see 20-cent and 30-cent rates again on frame, right? So if right now we're seeing 60-cent rates on frame, I think the bottom would probably be 50, 55 cent. In other words, I could be wrong. I just don't see carriers, whether it's a layered program or a single carrier, ever willing to take on the risk of structures and complexes that are entirely 100% made of wood without sprinklers for less than 50, 55 cents.
So you made 2 points there. Wood and sprinklers. So how much difference? So like I'm a realtor, I'm taking clients out to look at properties, and I show them a wooden built structure and I show them a concrete, like Menehune Shores, for example, or Royal Maui, and they're solid concrete.
Yep.
What's going to be the difference in the insurance costs to the association, which then trickles down to the homeowners' monthly dues? What do we? Any idea what?
Yeah, so you would think there'd be a big difference, but let's use a low-rise frame complex. Pick a complex in Wailea or Keonakai. These are 2-story buildings, right?
Yeah, so Grand Champions.
There you go, Grand Champions. Forget about fire for a minute, the most common condo claim is a water claim, okay? And as you know, water can do tremendous damage to a condo unit. A lot of their people aren't there in between bookings. There's water filters. There's old plumbing valves. These places were built.
Yep.
Yeah, these places were built in the 70s and 80s. Most common water loss, or the most common loss is going to be a water loss. Okay, so you would think, oh, okay, Menehune Shores, concrete building, right? It's more fire resistant, which it is. But if someone pops a water line on the 5th floor, it's going to trickle down into 5 units below it. Whereas if there's a water claim on the 2nd floor at Ikolu or Akahi, it's only going to affect 1 unit below. So there's different risk dynamics that the underwriters are going to look at.
Taller buildings have higher risk because there's more opportunity for that water damage to affect more units.
Absolutely. If a water line pops on the 5th floor and damages 5 units, it could be a $250,000 claim. Right?
Right.
If there's a kitchen fire at a 2-story complex, but it only affects 1 or 2 units, that could be a smaller claim. So,
okay. So bottom line is whether it's a concrete or a wood building, that's really the fire up until we became aware of it in Lahaina hasn't been the biggest cost to the insurance companies. It's really the water, and that happens in any building.
Yeah, and that's going to happen in any condo complex, and we're not going to see it much on Maui. But do you remember the Marco Polo fire in 2018 in Honolulu in a high rise?
Oh, kind of.
So there was a huge fire in a high rise condo building, and 4 people lost their lives. They couldn't get out. The flames, high rise, lots of wind coming through. We're not going to see it on Maui, but pretty soon there's going to be high-rise structures, and there's only a couple over in Kaanapali, Lahaina side, but on Oahu, there's hundreds of them. Pretty soon, those complexes won't be able to get insurance unless they retrofit with sprinklers. Okay.
Wow.
Most of the buildings here on Maui, Menehune Shores, Maui Park Shore, just name them. They're all Maui Sunset. They're all 5 stories. That's low rise. Okay.
Right.
Someday, maybe not in our lifetime, it might come down the pike, but there's a push right now amongst associations to retrofit any building that's, I think, more than 9 or 10 stories on Oahu. They're going to need to get sprinklers. Otherwise, the association won't be able to get property insurance. But how about liability? If there's a fire and people die, the lawyers are going to sue the association, and they're going to say, well, there's no sprinklers. In this day and age, you should have had sprinklers, and the jury's going to side with them, right?
Yep.
So the general liability carriers aren't going to do the insurance on these high rises until they they get sprinklers.
So that's an interesting point too. I guess if you're in one of those high rises and you don't have sprinklers, being proactive about it, because it's,
Right.
I'm sure, a very expensive journey to retrofit sprinklers into a high-rise building.
Rip the Band-Aid off now, spend the $2 million, because with inflation and future costs and the Lahaina rebuild, in 5 years, that $2 million sprinkler retrofit might be $4 million, $5 million, right? So pay me now, pay me later.
So for any of you property manager or property presidents and board members that are watching this that are in these high rises, take heed and don't think, oh, we can't afford it, because it's a bigger, greater risk down the road. So
correct.
Great. I mean, again, so many things I didn't either know or never thought about, and that's why I really wanted to have you join us with this call. What else are we looking at? How about we talked a lot about condos. Let's flip over. We got a little bit more time. Let's talk about homeowners. I mean, individual freestanding homes. Have they been dramatically affected? Anything we should be telling our homeowners, say, hey, think about this, whether our audience is here in Hawaii, but it's all over the country. Any advice you can give them, knowing what you know about the insurance space, and what they should do with their insurance carrier?
Absolutely. So we're seeing 20, 30, 40, depending on the carrier, 50% rate increases on the fire, the HO3, the homeowners policy. Haven't talked about hurricane yet, but we're starting to see rate increases on homeowners, all due to this rising cost of reinsurance. Because we're in a hard market means less coverage for more money, less throw-in coverages, more underwriting scrutiny. So when someone comes to me with a house, and I'm speaking for my markets, I'm not speaking for the captive agents. So in the beginning, I said I'm an independent broker. I can't write policies with State Farm or Allstate or Farmers or Geico. Those guys are captive to the name on their name tag. So whatever they're doing, I hear through the grapevine, but I don't get the emails on their underwriting requirements. But back to my markets. All of my markets want to see updates to roofing, plumbing, and electrical. Those are the three things that cause the most property claims. Okay. So if someone comes to me with a house built in 1999, sounds like a relatively new house, doesn't it, Tom?
Yeah, sure. I mean, in our world, absolutely.
If it's got an original roof on it, that roof is 26 years old. Here's the kicker. Most roofs are composition shingle. They're made of tar and sand. In a place like Arkansas, Ohio, Wisconsin, that it has a normal 3-4 season weather pattern, we get 336 days, according to the almanac, of sunshine in Kihei and Lahina in most parts of the island a year, which is why everyone wants to be here. Right. That means our shingles get baked by our UV10 sun 4 times, 5 times longer. The day of the Lahaina fires, everyone wants to talk about the actual fires. As an agent, I turned in dozens of wind-related roof claims that had nothing to do with the fires, because we had 90-mile-an-hour winds, if you remember.
Yep.
Shingles in Hawaii simply do not perform. They don't flex, and they don't last as long. And the underwriters now know that, and they're scrutinizing roof replacement. People have asked me, well, I'm going to hire this. You've seen them online. I'm going to have a coating put on. Nope.
Yeah, Roof Max. I was just looking at that the other day.
Doesn't matter. I would advise my clients, whether it's a condo association or a homeowner, buy the cheapest shingles you can and have a roofer replace it every 20 years, rather than pay the extra 30-40% for the 30 or the 50-year composition shingle. If it's composition, the underwriters are going to scrutinize that roof material more than anything.
Got it.
Tile, metal, we can get a little more flexibility with the underwriters, but they want to see roofers inspect the roof and make sure that it's okay.
So it can't be your home inspector when you're buying it. They want actually a roofer inspecting it?
No, it can be your home inspector.
Okay.
It can be. So, and that's another thing when someone comes to me for an HO3, if it's a new purchase.
What's an HO3 again?
Homeowners policy.
Okay.
Yeah. So I always ask for the inspection report. Hey, do you have an inspection report? Yes, I'll send it over to you. And then one of our trusted vendors will send me the link to the inspection report.
Got it. And then they're looking at roof, plumbing, and electric. And that, so this is talking about somebody who's buying a house, not when you're just going to requote your insurance. You're buying a house. Your insurance man asks for your home inspection, and then they're going to look and see if there's any roofing, plumbing, or electrical problems. And then your guys are going to call that out. Because I think I had this happen to me.
Yeah.
The insurance company says those things need to be fixed either by a certain date, and you need to prove it, or something like that. How does that work? I mean, what are you seeing the carriers doing?
Yeah. So sometimes they just won't do it, right? If I send an inspection report off to First Insurance, and when you look at the beginning of an inspection report, there's red, yellow, and orange, and there's various levels of severity. Okay. If there's a lot of the red style, safety, immediate concern, no covers on boxes, random wires sticking out, right? Plumbing valves and fittings that look old. You can't just buy a fixer-upper and expect it. And again, I'm talking my markets. I can't speak with the others. Call those other companies, get quotes. My markets want to know what's going on because they've paid these claims.
Right.
And I can help them navigate through that process.
All right. We got to cut it because we're running way late. But one last question. When it comes to your insurance policy, most people, every year their policy just renews. They don't think about it. They don't look at it. Should the consumers out there, should they be, re-estimating or re-quoting their policy on a regular basis?
In this market right now today, my honest advice to those that call me, because there's those that don't know about the market, they've gotten this increase and they've been trained to call 1-800-INSURANCE, and 15 minutes could save you 15% or more on your home and auto insurance. If you have a policy and it's renewing and you haven't gotten a letter that says you need to do a bunch of stuff, or you're not being non-renewed, in this market, keep your current policy. I'm happy to take a look. I have more flexibility as the values go up. I have more options, but on the normal house like mine, like yours, like whatever you're seeing in Kihei, I would argue if you've got a renewal and it's not broken, don't try to fix it right now. And I wish that wasn't the case, but someone comes to me looking for a new policy. When were the roofing, the plumbing, and the electrical updated? Oh, well, it's original to 99. They might be within the underwriting guidelines of the insurer that wrote their policy 5 years ago, but for a new policy today, they'd be required to have updates, proof of updates. And because they haven't had claims for 5 years, 10 years, that company, whoever it is okay staying on their risk, but a new insurer, just based on the age of those systems, won't take them based on today's underwriting guidelines.
Great. Jamie, thank you so much. I know you got to bounce into another meeting. I really appreciate all the knowledge you brought to this show. Hopefully everybody appreciates it. Please, guys, comment. If you've gotten this far into the call, comment. Say thanks to Jamie for all of his information. Jamie, how do people get a hold of you? And again, what company are you with?
I'm with Insurance Associates. I'm an independent agent. My number is, and I can put it in the comments once we post, my number is 808-633-6082. My email address is Jamie, that's JAMIE, at insuringhawaii.com. So that's Jamie at insuringhawaii.com. Available for you. Happy to help in any way that I can.
Perfect. And Jamie, thanks so much. I really appreciate it. Aloha, everybody. And remember, if this is the first show that you've watched and you like it, let us know. This is a different format that we normally do. It's a really long format. If you've watched all the way through, thank you so much. And hit the subscribe, hit the bell, share some comments, and share this show if you think it will be helpful to you, your friends, your neighbors, your family. Aloha, everybody. Take care and be amazing.